The markets are oversold. So we're going into a seasonally strong period while the markets are oversold. Here is the daily RSI. It fell to 35 on the S&P. And as you can see, that's the lowest reading all year, except during the tariff wars. Now, that wasn't a bad time to be buying stocks then. I think it's a pretty good time to be buying stocks now. But the latest AAII net bears less bulls shows there is a huge jump in the number of bears. That's the thing. When everyone's bearish in the midst of a market being oversold and now entering a seasonally strong period, I'd kind of lean to the fact that this is going to catch a lot of people by surprise.
Tom Lee opens by zeroing in on the mood in the markets right now. Turbulence. After hitting highs in October, the S&P 500 has slipped about 6%, with 3.5% of that coming just this month. Following 6 straight months of gains, the sudden pullback feels jarring, but in context, this is actually the 7th 3% plus dip of the year. It's uncomfortable, but not unusual. Yes, it's the sharpest drop since the United States tariff war. But Lee argues the real question is whether a 6% slide changes the broader outlook. His view, it doesn't. The long-term bull trend is still intact, and his year-end rally expectations remain unchanged. If you're finding value in the content, make sure to like the video, subscribe, and turn on notifications. Check out our other breakdowns on crypto and the wider digital asset market, and share your thoughts in the comments. Every interaction helps the channel grow. Enjoy the video.
Well, what's happening here? Well, there's turbulence in the market now, and that's what's causing some underperformance of granny ETFs. But we believe the year-end rally is intact. So let's take a look. Since the October highs, the S&P 500 is down nearly 6% and down 3.5% for the month. That's pretty significant underperformance, and it feels terrible, especially given stocks had been up for 6 months in a row. But if you zoom out, you can see that this is the 7th correction of roughly anything over 3%. So, and it is the most severe correction, however, since the tariff wars. So the question is us being down 6% really changing the bigger picture? In my opinion, not really. I think we're still on track to have a year-end rally and the S&P reaching 7,000 to 7,300. And here's 5 reasons for this, okay? Number 1, the government shutdown ended. Keep in mind, this was the longest government shutdown in history. It was 43 days. There's a lot of disruption that comes from that, and you can imagine a lot of anxiety. The second is that the Fed is going to be cutting in December, even if they're cutting hawkishly. Now, you might say, didn't Powell kind of rule out a Fed cut? Well, take a look at Polymarket. It's been very good at predicting outcomes, and you can see that the latest Polymarket shows a 67% probability of a Fed cut in December. That's pretty good. Now, there's a 32% chance of no cut, so of course the market is debating between the two. But again, we lean towards the fact that the Fed will be cutting. The third is their seasonal strength. Now, the market's already shown its strong hand because it was up 6 months in a row from May to October. That's only happened 6 times in history. Here's the thing. In the 6 prior instances, the market gained 21% over those 6 months. And in 2025, we gained 23%. So it's a pretty strong market. But let's look at that November to December return. The median gain is 5.4%. In fact, it's probably arguably better than that because 5 of the 6 of these instances was a rally, whereas there was one decline, which was 1936. Now remember, that was really in the aftermath of the Great Depression, so I'm not inclined to look at that as an example. In fact, if you look at the 2 most recent instances, even the most 3, markets were really strong into year-end. Okay, now the 4th reason I'm constructive of the year-end is the markets are oversold. So we're going into a seasonally strong period while the markets are oversold. Here is the daily RSI. It fell to 35 on the S&P. And as you can see, that's the lowest reading all year, except during the tariff wars. Now, that wasn't a bad time to be buying stocks then. I think it's a pretty good time to be buying stocks now. And finally, investor sentiment's bearish. Now, that's going to happen because the market's been grinding down for 3 weeks. But the latest AAII net bears less bulls shows there is a huge jump in the number of bears. That's the thing. When everyone's bearish in the midst of a market being oversold and now entering a seasonally strong period, I'd kind of lean to the fact that this is going to catch a lot of people by surprise. There's a short week this week because of the Thanksgiving holiday. And I'd say the most notable will be on Tuesday with the September core PPI. The reason we don't have CPI, though, is the US canceled the release of that report for October. They just didn't have the data available to actually calculate CPI for October. And it follows on the fact that they had to cancel the October jobs report for the exact same reason. They couldn't collect the data. And as for earnings, the only granny shots reporting this week is John Deere on Wednesday before the open. So let's go over granny stock individual performance. In the large cap GRNY and in the income GRNI, they have an identical portfolio. Here is the top 5 performers. Okay, Google, TJX, Deere, PNC, and Monster Beverage. Now, the bottom 5 performers did a lot worse than the top 5. That's why the ETF actually fell. You can see it's Palo Alto Networks, Palantir, Robinhood Strategy, and AMD. Now, these are all double-digit declines. Did the fundamentals change? No, but these are AI and strong year-to-date performers. And you know what? As the markets gets nervous, and it's down 6%, you're obviously going to see people selling their winners. Now, on the SMID side, here are the top 5 performers. Dycom, Western Alliance Bancorp, Install Building Products, Lumentum, and East West Bancorp. The bottom 5 were Sanmina, Riot Platforms, Roblox, IonQ, and Bloom Energy. And again, those bottom 5 did a lot worse than the top 5, but it's really showing you the AI and strong year-to-date performers are seeing profit taking. And as far as themes go, the PMI recovery theme outperformed, as did seasonality, and the large cap grannies easing financial conditions outperformed.
We need to understand sort of where you stand on all of this. Also, I should say there's been a bigger even fall in some of the other cryptocurrencies, but you've been a Bitcoin man. So where do you see the floor at this point, and where do you see the upside?
Yeah, well, let's put this all in context real quick. So over the last decade, Bitcoin has drawn down 30% or more 21 different times. Of that, 7 of them have been 50% or more. That's like having a global financial crisis every year and a half for a decade. So Bitcoiners are used to this. Now, who's not used to this are the people who are coming from Wall Street. They're not used to this type of volatility. You know, global financial crisis, there is literally people still fearful of that happening again. And so I think that what we're watching is as the rotation of the holder base happens, these new people are very, very fearful. We're going into end of year. There's things around bonuses. People are trying to figure out, should I actually sell this asset that I thought I was really excited about? And I think that's putting some downward pressure on the price. Now, in terms of that drawdown, given that there's been 21, 30+% drawdowns, I do think that a 35% drawdown that we've seen from the all-time high is pretty healthy reset. And I think that there's a question in the industry. Is this going to be one of these very large drawdowns that we've seen in terms of these bear markets of 70, 80%? Or is this simply something that is more normal? And we should expect this reset to then provide a new base, and then we go back to all-time highs over the next couple of weeks or months.
And where do you stand on that question that you just posed yourself?
You know, I heard something pretty interesting. Matt Siegel over at Van Eck said, well, Bitcoin's, in terms of Bitcoin's volatility, has been cut in half over the last year or two. And so if that's the case, if we're used to 80% drawdowns, maybe now the drawdowns are about 40%, right? You would expect that if the volatility has been cut in half. Well, we just saw a 36, 37% drawdown. And so I do think that as volatility compresses, people will be disappointed to the upside because it's not going to have these blow-off tops that they expected. But also there may be some, safety in terms of these 80% drawdowns are gone as well. And so I tend to think that we probably are somewhere around the bottoming. Again, if you see the fear and greed index at, I think it was 8 for Bitcoin, 6 in equities, that tells me that you can't stay there that long. And so I think that we might just go sideways for a while here and then start to kind of grind back up over the next couple of weeks.
Anthony Pompliano also breaks down Bitcoin's market behavior, noting that the recent 35% pullback is nothing out of the ordinary. In the past 10 years, Bitcoin has dropped 30% or more on 21 separate occasions, including 7 corrections of over 50%. For long-time crypto investors, this is standard volatility. But traditional Wall Street entrants, used to calmer assets, often react nervously. Pomp highlights a few important points. Bitcoin's volatility has actually decreased over time, so the massive 80% crashes of past cycles may now look more like 40% declines. In that context, a 36-37% drop is entirely within the new normal. He also points to sentiment indicators. The Bitcoin Fear and Greed Index recently fell to 8, and the equity index hit 6. Such extreme fear typically signals capitulation, an end to selling pressure, not the start of a deeper collapse.
Anthony, one of the big questions has always been how much leverage there is in the Bitcoin universe and whether there gets to be a point, and I don't know what the inflection point is, where there are enough margin calls that it effectively becomes this sort of self-fulfilling prophecy on the downside. Where do you stand on that? I mean, obviously, we talked to Michael Saylor just about a week and a half ago. He obviously represents a huge part of the market, too. Also, there's a number of ETFs now that represent a big part of the market. So how do you see that piece of it?
Yeah, well, there's a lot more leverage in the system on October 8th and 9th, right before the big liquidation. And so I think that, again, part of that healthy reset is that we went from higher degrees of open interest and leverage to today something that is much more normal. And I think that, again, that fear and greed index is a great signal as to how bullish people are. And, you know, there's always the quote of you want to buy when there's blood in the streets. I don't think I've ever seen the equity fear and greed index at 6. The Bitcoin one going to 8 is very, very rare. And so I think that you're not going to see high degrees of leverage whenever you get that fear. And so that gives me, great confidence that we're probably not that far from having bottomed.
So are you buying right now? And what do you see as the upside in terms of how you look at even 12 months out? Because we've heard lots of predictions that would mean that the value would effectively have to double, triple, or more, actually, to reach some of the expectations we heard probably 12 months ago.
Yeah, I've been coming on the show for a long time, and every year I try to end up with more Bitcoin than I started the year with. This year I will have accomplished that, and also I will end Q4 with more Bitcoin than I started Q4 with. And so I think that if you've been doing this for a while, you understand that this is part of the volatility. The volatility is actually a strong signal. It's not a negative. I actually would be worried if Bitcoin's volatility essentially was zero. You need volatility for the asset to go up. Bitcoin is up 240x over the last decade. It's about a 70% compound annual growth rate. We are not going to continue to have that level of growth moving forward. But if we get something that is 20, 25, 30, 35% compound annual growth rate for the next decade, you're going to outperform equities. And I think that's why a lot of Bitcoiners are very excited about this asset as part of their portfolio.
Do you feel the same way about Ethereum or Solana? I should say, by the way, down even more than Bitcoin.
Yeah, what's been pretty interesting is I think that going into this bull market, people thought, okay, Bitcoin will be the lead in terms of movement on a sequence basis, but the alts historically have outperformed in these kind of euphoric blow-off tops. We haven't really seen that as much as I think people expected. And so instead what we've seen is that Bitcoin has remained kind of the dominant asset. A big part of that is that Wall Street embraced it first. Now, over the last couple of weeks and months, we have seen Wall Street start to take a look at ETH and Solana and some of these others. But I do think that there is still a kind of category creation, a category winner in Bitcoin as a store of value. That is probably the largest total addressable market. And so I think that Bitcoin will stand alone and it will continue to be the king of the crypto market. Doesn't mean the other things are going to go to zero. Doesn't mean that investors aren't going to go put that in their portfolio. I just think that Bitcoin is able to kind of obtain a very special place in a portfolio. And that's why you see so much capital flowing in. And that's why you see Bitcoin dominance continuing to be so high compared to the other cryptos.
Pompliano stresses that Bitcoin's current drop is normal. In the last decade, Bitcoin has had 21 pullbacks over 30%, and long-time holders expect this volatility. It's the newer Wall Street investors who are shaken. With year-end pressure and fear rising, some of the selling is emotional, not structural. He sees the recent 35% decline as a healthy reset, not the start of an 80% crash. Bitcoin's volatility has dropped over time, meaning today's big corrections are closer to 40%, not the extreme drawdowns of previous cycles. The Fear and Greed Index hitting 8 for Bitcoin and 6 for equities points to capitulation, which often signals a bottom. Excess leverage has already been flushed out, and Pompliano continues to accumulate Bitcoin, expecting long-term returns in the 20-35% annual range. Bitcoin still leads the market, even as interest in ETH and Solana slowly grows. If you're enjoying the analysis, make sure to like and subscribe.